In this video, we're going to look at how Fitch assigns issue ratings to different classes of debt obligations issued by non-bank financial institutions, or NBFIs. Please refer to the video, Assigning Issuer Default Ratings to Non-Bank Financial Institutions, for an outline on how we assign issuer ratings. Issue ratings reflect Fitch's view of the overall level of credit risk attached to specific financial commitments, incorporating an assessment of both the likelihood of default, or non-performance risk, on the specific obligation and of potential recoveries for creditors in case of default or non-performance. This is reflected in the notching up or down of the issue rating relative to the issuer default rating, or IDR. For senior obligations, the anchor rating is the long-term IDR. For junior obligations, subordinated and hybrid securities, the anchor is usually the standalone credit profile, or SCP, but can also be the long-term IDR. This slide highlights the criteria applicable for each class of debt. For senior secured and senior unsecured obligations, the NBFI criteria would be applicable. For traditional subordinated or hybrid securities that are not prudentially regulated, Fitch applies the corporate hybrids treatment and notching criteria. Where traditional subordinated or hybrid securities are prudentially regulated under either a bank or insurance company framework, then Fitch will apply either the bank rating criteria or the insurance rating criteria, respectively. For NBFI issuers with an IDR of BB- or higher, we typically follow a generic approach to assigning issue ratings, while for issuers with IDRs of B+ and below, we follow a bespoke approach by conducting a recovery analysis and assigning a recovery rating, or RR. This slide deals with the notching of securities for an issuer with an IDR of BB- or higher, where instrument ratings are equalized with or notched up or down from the IDR based on their security position and payment priority, considering recovery expectations. The typical notching ranges are highlighted in the chart. For secured instruments, there is the potential to notch up from the long-term IDR, depending on recoveries. If the IDR is in the BB category, the issue rating may be notched up by 3, but capped at BBB-. For more than a one-notch uplift, recovery expectations must be at least superior, supported by liquid assets within a strong ring fence, and collateral package and/or predictable cash flows, often underpinned by high-quality long-term contracts and backed by conservative loan-to-values. For senior unsecured instruments, the rating is typically equalized with the long-term IDR, although it can be notched down if there is effective subordination or high balance sheet encumbrance. In this slide, we consider instruments issued by an NBFI rated B+ and below. For these issuers, we follow a bespoke approach by conducting a recovery analysis and assigning a recovery rating, or RR. RRs range from RR1 for strongest recovery prospects to an RR6 for poor prospects, with a typical notching indicated in the table. Assigned RRs might also be subject to country caps, depending on an issuer's jurisdiction. The recovery analysis to arrive at an RR involves 3 steps that estimates a post-restructuring or post-liquidation enterprise value, estimating creditor claims, and distributing the enterprise value according to the priority of claims.